Should you or should you not trade trend lines? There's definitely plenty of ways that you can implement this tool into your strategy, but it's a very specific way. And whenever you use trend lines, you definitely have to make sure that you won't become part of retail liquidity. What we can see over here is a naked chart, and I'm going to be explaining you guys some of the basics of trend lines. Because whenever we have trend lines, you have to realize that whenever we touch that trend line, that people, their behavior changes. And by people changing their behavior, that also means that liquidity moves from the upside to the downside. What do I mean by that? I mean that as soon as we have a trend line like this, every single time that we touch the trend line, it means that we are forming a lower high. Now, after we break down further, it means that price is continuing its bearish trend. What happens when people identify a basic trend line is that they start shorting based on the trend line. Now, what happens is when people start shorting, they are putting their stop loss above a certain high. It means that people that are shorting this lower high are putting their stops above this high over here. People that are shorting this high though, most of them put their stops above this high over here. And also the people that had their stops at first over here, after this lower high, they often tighten their stop loss to the previous lower high. So basically, by creating these trend lines of support and resistance, we are also building up a lot of liquidity to the upside, or when we have a trend line of support, we are building up a lot of liquidity to the downside. It's what we call trend line liquidity. And this is where retail traders make the most common mistake, because every time the price comes close to a trend line of support or resistance, they short it back down when a trend line acts as resistance in the past. Whenever it comes to a trend line of support, they start to long it based on just that trend line and where they're going to put their stop beneath the previous higher low. And by retail trading these trend lines, they are building up the liquidity that smart money can target in order to either accumulate brand new positions or to unload accumulate positions that they accumulated at lower prices, for example. Now, if we dive into a few examples of why trend lines won't work, because a lot of people don't only use trend lines to long support or short resistance, but they also are breakout trading trend lines. And now, in my opinion, the thing that you never should do is use trend lines as support or resistance, because if you do, it's very easy for you to become part of retail liquidity. Now, in my opinion, besides the fact that you shouldn't use trend lines as support or resistance, you can use trend lines to potentially identify potential breakout. But there's two different ways. And one way you definitely should not use, because if you do, you will get trapped into trading wrong and invalid breakouts. But if you use the second way, you can use trend lines to make profit on potential breakout trades. Now, the first way is something that I will be showing to you guys right now. And I have two examples for you guys. Over here, we see, if we go to the 1 hourly time frame on Bitcoin, we see a trend line of resistance, right? So the trend line acts as resistance once, twice, 3 times, 4 times, 5 times. Now, the 6th time that we test this trend line, it is almost breaking out. So what happens is people start breakout longing, correct? Now, they long just because of a potential breakout of this trend line, but it's not a valid one. In the next example, I will show you guys when trend lines are valid to trade for a potential breakout. But what happens is they get trapped inside of a fake breakout. Where do we think that they put their stops? If they long the breakout like this, they put their stops beneath this low or beneath this low. And see what happens after the fake out of the trend line. Price pushes down to take all of the stop losses of the breakout trader. So retail traders not only trade support or resistance trend lines to accumulate long and sell positions, but they also trade fake breakouts. And you don't want to get caught inside of those fake breakouts, because you always end up getting wrecked. Now you're probably wondering, Guru, when are we looking at a valid breakout? First, I'm going to show you guys one more example of a fake breakout before I show you guys proper examples. Over here, we have a trend line of support, right? If I go to the 4-hourly time frame, beautiful trend line of support. Over here, we have a fake breakdown of the trend line, right? Where people start breakdown shorting Bitcoin because everybody was talking about this trend line of support. They break down short Bitcoin with their stop above this high, or this high. So what happens after the fake breakout? We go for all of the liquidity that we have been building up over here because retail traders are breakdown shorting the wrong trend line. Now, when can we use trend lines? That's the question of today's video, because that's how we can make money. Of course, we have to prevent ourselves from making mistakes and from taking the wrong trades, but we also have to make sure that we take the correct trades in order to make money, of course. Now, when is a trend line valid? A trend line can be traded whenever we form a valid falling wedge or a valid rising wedge. Now, falling wedges often are formed during uptrends and rising wedges often are formed during downtrends. And I have a few examples for you guys of valid falling wedges and valid rising wedges. The first one being over here on the 1-hourly time frame. Now, what's extremely vital in order for a falling or rising wedge to be valid is that, first of all, you need either 2 taps at the top trend line and 3 taps at the bottom trend line, so 5 taps of the trend line in total. And second of all, you need either 2 taps at the bottom of the trend line and 3 at the top. So you need those 5 taps in order for the wedge to be valid. But that's not all. Besides these steps, while the wedge is being formed, the volume needs to drop lower and lower and lower. If volume is rising while the wedge is being formed, it's not a valid falling or rising wedge. So for example, over here, why is this a valid rising wedge? If we take the volume, we can see that besides the 5 taps, so tap 1, tap 2, tap 3, tap 4, and tap 5, while the rising wedge is being formed over here, we can see that the volume has been going lower and lower and lower and lower. And then at the breakdown, that's where you get the increasement in volume, and that's how you can spot a potential valid breakdown. Example number 1. Now let's move to example number 2. If we move to the 4-hourly time frame over here, we can see another beautiful example over here. Because what we can see, besides these steps of the trend lines, number 1, number 2, number 3, and at the bottom as well, number 1, number 2, number 3, we can also see that the volume while the wedge was being formed, and don't look at these crazy spikes, look at the general volume. It was dropping lower and lower and lower and lower, right? And then sometimes you have these crazy spikes, but especially this one on the daily time frame, which was basically the bigger picture and the same kind of structure over here, we can see that while this wedge was being formed, and once again we see these steps 1, 2, 3, 1, 2, 3, we can see that the volume while the wedge was being formed was extremely low and dropping lower and lower and lower and lower. And then over here at the breakout, you see a little bit of a volume spike, and this was a valid breakout. Okay, so very important. Never use trend lines as support or resistance. Okay, never try to long the support trend line, never try to short the resistance trend line, because you will end up as retail liquidity. Second of all, trend lines can be used to identify potential breakouts, but they can only be used for potential breakouts if we are forming a falling or rising wedge pattern. And besides the fact that we need to form a falling or rising wedge pattern, the wedge also needs to be a valid one. And it will be a valid one by getting 5 taps of the trend line. And besides those 5 taps of the trend lines, also the volume while the wedge is being formed needs to be very low, or at least drop lower and lower and lower while the wedge is being formed. If that happens, you can trade potential breakouts. So in today's video, we have answered a very important and very often asked question. Should we or should we not use trendline? And not like every single trader out there, I don't have a very strong opinion on it. I think you can use it as a tool for your trading strategy. as long as you use it in a correct manner. Now, if you guys do have any questions after watching today's YouTube video, feel free to let me know in the comments down below. When this YouTube video is being dropped, I'm probably celebrating my holiday with a few friends in Spain, but still, obviously, as always, I made sure that I provided you guys with some content. So if you do appreciate that, please also make sure to smash the subscribe button. And I'll catch you guys on Monday's video. Ciao, ciao!